morning. Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. We are in a new financial year, and when it comes to planning your personal finances, the earlier you get going, the better. So this week on the show, we take a look at the regulatory as well as tax changes that FY20 have ushered in and give you a head start so you can take stock of your money and your investments early on, and also look at some smart tax saving options as the year rolls in. Joining me today are Hemant Rustagi, CEO of Wise Invest Advisors, as well as Preeti Khurana, Chief Editor of ClearTax. Thanks to both of you for joining in. Thank you, Preeti, for joining us all the way from Delhi. Let's get first thoughts in. It is a brand new financial year, so happy fiscal 20. Let me start by saying that to you. Mr. Rustagi, opening thoughts, new year, new beginnings when it comes to our money.
Well, I think clearly if you look at your investment is an ongoing process. It also requires a lot of patience and perseverance. So how do you ensure that your portfolio remains on track? So it's very important that in a very disciplined manner, you keep looking at your portfolio. Now, when you start talking about new financial year, there's no relevance as such to do anything particular from the start of the financial year. But I think, like I said, it's very important to keep it disciplined. So if you follow the tradition of doing everything at the start of the financial year, that brings in discipline. And also there are a lot of things that you need to do. For example, you need to look at your fresh investment for the year. You need to start planning your tax saving investment. You need to look at your asset allocation. You need to see whether you need to rebalance it. So I think there is a lot of relevance in that sense from the start of the financial year. So I think it's the right time for investors to look at their portfolio and see what needs to be done.
Oh, absolutely. And our endeavor, the reason behind doing this show is hopefully to motivate all of you not to go to the last minute, the finishing line, and then make those, sudden rushed lump sum investments to look at tax saving. Tax planning perhaps is a better way of approaching it. So let's get in Preeti as well. Preeti, I'm guessing you've just ended your busy season, right? I'm guessing March is really, really busy when everyone's coming to you for tax advice. First thoughts?
I've realized now that every month is busy and every month has become important, especially April, when a lot of people will now start to get their increments because most of the corporates follow a financial year pattern. And this is an excellent time to actually start allocating if you've got a bonus or if you're looking at tax planning for the current financial year. A good time to set aside money. We are looking at slightly extra money because of standard deduction becoming 50,000 from 40,000. And then some of those who own two house properties will actually end up paying much lower tax because there's no tax on notional rent now on the second house property, which is self-occupied. So in that sense, this is a good time to sort of look at how much is going into debt-based products. Do I need to get into equity? What is my total tax outgo looking like? And then, how do I plan to allocate my money into my savings right from April? So good. I think it's a good time to look at all of these aspects.
Yes, absolutely. So even before you can plan your summer vacation, make sure you've planned your finances, your investments and your taxes, and then you can go out and start enjoying the rest of the year. We're going to come to a lot of the specific points that Preeti raised in just a bit. But let's take a step back. What should be sort of, the first sort of point on the to-do list if you're looking at personal finances, taxation, planning for the year as a whole? Do you start with insurance? Do you look at investments? Or is tax the first thing that you need to sort out? So how does one begin, sir?
I think there are actually 3 or 4 important aspects that one has to look at. What we have seen over the years is tax saving investments is something that gets sidelined. And I think we see a lot of people end up investing at the fag end of the financial year. I think it's time that all those investors who have been following this should change it this year. So the first priority clearly has to be if the increment is already announced, if not announced, it will be announced soon. You get fair idea of what you're going to get. So you can start planning on that. If you're investing in product like ELSS, for example, you know that the right way is to invest through SIP, and the right way also is to start right at the start of the financial year. So I think tax saving again has to be, and you need to make it a part of your overall investment plan.
Sure.
So many times what we have seen is that you're not able to get advantage of tax saving investment because you're not making it as a part of investment plan.
It's a side thought which suddenly sort of comes in by the end of the year and some random investment gets made.
Absolutely, and the fact is that it can actually create a big role in your wealth creation process. So I think that has to be priority. Second is you need to look at your asset allocation. It's very, very important because if we spend a lot of time at the start of the investment process to see where your investment should be, you need to see over a period of time whether it has changed and how much it has changed, whether it requires some kind of rebalancing. Because every portfolio that you design can take certain type of risk. The moment you allow it to drift, there is a risk of either the portfolio becoming very risky or becoming too conservative. So I think it's important to start looking at that. And as you rightly mentioned again, I think insurance is an important aspect. Risk management has to be the top priority. Even before you start investing or start doing anything about your investment, you need to make sure that you're well protected in terms of risk management. And clearly we're looking at life insurance, we're looking at health insurance, and we're looking at also creating an emergency fund. I think these are important aspects, and we have seen that to save tax, a lot of people have accumulated number of policies. I think it's important for them to realize that your risk cover comes from not number of policies, but also actually come from the sum assured that you have. So it's important that you relook at that, make sure that you start taking your risk management seriously, and if you need be, take a term plan, make sure that your health insurance is adequate, and create an emergency reserve at least for 6 months expenses so that you don't have any issues later on.
Absolutely. I couldn't agree more that even before you're thinking of investments, savings and wealth creation, first of all, are you adequately protected or not? So on that note, do give us some advice or some tips. If you're looking at basic insurance, a basic term plan, what would be the rule of thumb? I mean, the whole 10 times your annual salary, is that something that you go by?
That's a thumb rule that we've always been saying, that it should be at least 10 times of your annual income. But you also need to look at your personal situation side. If you have any loans or if you have any goals to achieve and you feel that this is not going to be enough, you should add that. Another important thing is, at a certain age you decide this is how much my sum assured should be, and we don't revise that, which is obviously not the right way, because as you move along, okay, requirements will increase, so you need to keep revising that. So it's not that once you've decided 1 crore is enough for me, and for rest of life 1 crore is not enough, going to be enough for you.
But you would still be a believer in term plans, because of late I'm getting a lot of feedback from obviously the insurance sector. A lot of people talking about ULIPs again, because they've, again, speaking of taxation, they've got a bit of a competitive edge over mutual funds because there's no long-term capital gains tax, at least on ULIPs. So when it comes to life insurance products, making sure that you're adequately protected, what are your go-to products?
See, I still feel that term insurance has an important role to play, because whether you're looking at ULIP or you're looking at any other product, it's not going to give you the kind of risk protection you require. I mean, irrespective of how much you may be investing, term plan has to be there. Now we talk about investment part, and we always say that you separate your investment from insurance. So once you've taken care of the risk factor there, now you look at what is the best investment for me, whether it's a ULIP or a mutual fund or an ELSS, for example. I think these are two products normally which are compared. I still believe that looking at the flexibility, looking at the kind of performance track record which has been there for ELSS, and the fact that the expenses are also getting revised from 1st April for even mutual funds.
Yes.
So I believe that ELSS still remains, keeps an edge on
a better choice.
Yeah.
Okay, fair enough. So I think that makes it quite clear. The first step towards any financial plan would be insurance. And now that we've got some of those pointers out of the way, let's move to the next step, which would be, of course, tax planning. So Preeti, now let me throw this back to you. There were some changes announced. I think the increase in standard deduction was a welcome change. There was also the increase in rebate. So it made it very beneficial for those who are earning less than 5 lakh rupees in a year. So if you could just go over some of the major tax changes for the year.
That's right. So your total income is exempt up to 2.5 lakhs. So nobody pays any tax up to 2.5 lakhs. Now, if you're able to restrict your total taxable income, which means you have a gross income, which includes your salary, your interest income, any other income that you may have, and then you have a sum there, that is your gross income. Now you reduce 80C or 80D or any of the section 80 deductions that you want to claim, and then arrive at rupees 5 lakhs. So if you have that number of 5 lakhs or less than 5 lakhs, then whatever is your tax calculated, you can claim as a rebate. So the maximum rebate there is 12,500, which is nothing but 5% of the number between 2.5 to 5 lakhs, which works out to 12,500. So that's the maximum rebate. But the moment you cross rupees 5 lakhs, like if you are sitting at a 5 lakh 5,000 or a 5 lakh 10,000, then you end up paying the full tax. So you pay tax from 2.5 to 5 at the rate of 5%, and whatever is in excess of 5 lakhs, you'll pay at the rate of 20%. So that's a huge tax outgo. So you should actually at the start of the year try and have a close estimate of what your total income is like, and then look at what are the deductions you can claim. But if you're not able to restrict it to 5 lakhs, then of course you end up paying taxes. So it's more applicable for cases who are on the marginal. So if you are sitting at a 6 or 6.5 or maybe up to 7, that's when you can end up paying zero tax if you plan your taxes smartly. But of course, those who are higher, they may find it actually nearly impossible to come to that 5 lakh number.
Well, that's right. But at least for some of us, this would amount to a big relief. And if you're looking at some smart tax planning ideas, and you can really avail of this benefit.
Now, what are the various ways to go, get there? And also, like, this is applicable to, in fact, anyone who's salaried, individual taxpayers. I think the 4 main pillars of going about your taxes is, of course, maximizing your Section 80C. Now, that could be done through various ways. You can do ELSS. We spoke about ELSS. Or you can actually do a PPF. Now, if you're risk averse, you're looking at an assured return, you don't want to pay taxes on exit, that 80C PPF is an excellent way to go about it. So that's the first one. The second one I would say is looking at how much is your EPF. So EPF, while that is also eligible under 80C, but EPF in itself is an excellent product if you're looking at, assured and safe investment. And you can also explore VPF. So let's say if you're sitting at a 6.5 lakh or a 6 lakh total income, and you're you can actually look at contributing slightly higher to your EPF fund, and then claim a deduction and also create savings for your retirement. Another excellent product I would say is NPS. So definitely, like the first one I would say is 80C, then looking at what your PF accumulations are like, your employee provident fund, and thirdly looking at NPS as a retirement product. So NPS comes with the benefit of offering you a retirement product which is linked to the markets. Returns are better. Of course, we're looking at a long horizon, and the withdrawals may be taxable up to a certain extent, but it's an excellent product for those who want to now start saving for their retirement.
Now, Preeti also raised some important points with respect to NPS and the EPFO itself, the tax saving vehicles in the country, and there are some important regulatory and taxation changes even with respect to these. So we will take a quick break, and when we come back, we talk about these important changes with the National Pension Scheme as well as the employee provident organizations.